In the last 14 days, roughly $190 billion has evaporated from the market value of U.S. defense and aerospace companies. 10-year Treasury yields have ticked up by 0.35 percentage points. A defense budget of $890 billion that investors treated as a boring certainty has suddenly become a political hostage. My name is Warren Buffett. I'm not running for anything. I'm here because if the people in Washington mismanage this standoff, it's your retirement they are experimenting with, not theirs. On the surface, this looks like just another fight over spending. Congress has blocked the new defense budget. Trump has chosen to double down instead of bargain. The headlines are about winners and losers in a partisan showdown. The market is reading a very different story. The operating system of American governance just glitched, and no one is sure how long the screen will stay frozen. Most folks see a defense budget as a big abstract number on cable news. Markets see a cash flow engine. Every dollar in that $890 billion flows down into factories, shipyards, suppliers, software firms, and small businesses on Main Street. When that flow is interrupted because the president and Congress want to teach each other a lesson, it doesn't just bruise egos. It changes the price the world is willing to pay for owning America. Here's the twist most people miss. Markets are not punishing America for spending too much or too little on defense. They are punishing America for looking like it can't execute anything on time. You can model a hawkish budget. You can model a dovish budget. You cannot model a government that turns its own payroll into a bargaining chip. If you're between 50 and 70, this is not theory. It lives inside your statements. A retiree in Florida with $480,000 in savings, 40% in bonds, 40% in broad U.S. equities, 20% in cash looks conservative on paper. But inside that neat pie chart are defense contractors, regional banks that serve military communities, REITs that own housing around bases, and bond funds full of treasuries. When this budget blockade began, that retiree quietly lost around $36,000 in 2 weeks. No one sent her a letter saying, "This is the cost of political theater." In Omaha, I've spent most of my life treating companies like long-term partners. If the CEO of a firm that held your pension said, "I'm willing to freeze an entire division's budget to prove a point to my board," you'd sell by lunchtime. Yet when a president does the equivalent with Congress, millions of people cheer as if it were a reality show. That gap between how rational we are with a stock certificate and how emotional we are with a ballot is exactly where investors get hurt. Think of the United States as a holding company with several major subsidiaries: defense, energy, healthcare, infrastructure. Right now, the defense division throws off steady cash and anchors jobs in thousands of communities. When Congress blocks its budget and Trump tells his allies to stand strong instead of cutting a deal, credit markets don't see patriotism. They see a management team willing to gamble the cash flow of an entire division for headlines. In a small town in Ohio, a contractor that supplies parts for military aircraft employs 2,800 workers. Under a normal budget, it renews multi-year contracts with a 95% probability and borrows at 4.6% to expand its plant. Under this standoff, the renewal odds feel closer to a coin flip. The bank notices. Overnight, the expansion loan is repriced to 6.1%, and the credit line is trimmed by 15%. The company delays the new wing of the factory, freezes hiring, and cuts overtime. The local diner, the car dealer, the dentist's office all feel the slowdown long before a single missile order is officially canceled. This is what I mean when I say the real risk isn't in the headline number, it's in the trust behind it. For decades, America earned a quiet premium in global markets because investors believed our budgets, however imperfect, would get done. That trust lowered our interest costs and lifted your 401 values year after year like a slow, steady tailwind. Trump's way of doing politics turns that tailwind into a crosswind. He doesn't just argue about line items. He questions the legitimacy of anyone who disagrees, then invites his supporters in Congress to prove their loyalty by blocking the very machinery that keeps contracts, paychecks, and interest payments flowing. From a campaign rally, that looks like strength. From a balance sheet, it looks like a rising discount rate on the future. If you own index funds, municipal bonds, or a simple target date retirement plan, you are not a spectator to this experiment. You are the counterparty. Every extra fraction of a percent the world demands to hold, our debt will show up, not in a tweet, but in the cost of rolling your mortgage, in the squeeze on Social Security adjustments, in the lower multiples assigned to the companies you quietly own. When trust erodes in a company, the stock price does not fall in a straight line. It slips, stabilizes, then slips again as each new disappointment confirms the market's doubts. Countries work the same way. What we are seeing in this block defense budget is not a one-off argument. It is an early signal that the world is starting to treat America less like the safest asset on earth and more like a management team that enjoys flirting with the edge. As an investor, I've learned one simple rule. When leadership treats trust as expendable, the cost does not show up tomorrow. It compounds over time. And right now, the compounding is working against you. Under the surface of that $36,000 loss, the Florida retiree just took lies a deeper shift, one that rarely makes the evening news but quietly rewrites the math of American stability. When the defense budget froze, derivative spreads on government-linked industries widened by an average of 18%, Treasury liquidity thinned for 3 straight sessions, and U.S. credit default swaps, usually boring, barely moving instruments, ticked up to 42 basis points, the highest since 2013. That small movement means something simple. Lenders are beginning to price in political dysfunction the way they price in natural disasters. You don't need a government shutdown to lose money anymore. You just need Washington to look unreliable for long enough. You can see that unreliability in places that never asked to be part of a political feud. A small manufacturing cooperative in Wichita, producing avionics wiring harnesses, saw its pending Air Force renewal pushed from Q1 certainty to Q3 review. That delay alone forced them to break a $2.4 million equipment order into installments. Their supplier reacted by raising prices 7%. The cooperative's margin target fell from 12% to 6%. No one on Capitol Hill will ever hear their name, but their balance sheet now bears the cost of Congress and Trump using a defense budget as leverage. These small shocks carry bigger consequences. The S&P 500 defense subset fell 11% in 9 trading days. Bond funds overweight in aerospace debt logged their worst outflows since the early pandemic. Over 1,100 small business loans tied to defense-adjacent industries were paused for reassessment, according to one mid-tier commercial bank. That pause translates directly into postponed retirements, delayed home purchases, and a growing sense among older Americans that the ground under their feet is no longer as firm as it was 10 years ago. Inside boardrooms, the tone shifted quickly. A fictional but entirely plausible CEO, let's call him Eric Dalton of Northridge Dynamics, told his directors last week, "We're not delaying our R&D because the Pentagon lacks money. We're delaying it because Washington lacks predictability." That single sentence captures the market's real fear. It's not austerity. It's volatility manufactured by people who know the cameras are watching. For Americans between 50 and 70, volatility isn't an abstraction. You don't have 40 years to recover from political mood swings. You have maybe 10, maybe 15. If you're already drawing from your retirement accounts, each downturn locks in losses you cannot reverse. And if you're planning to retire soon, every spike in bond yields cuts the present value of your future Social Security payments. A 1 percentage point move in long-term rates can wipe out what took you 5 years of disciplined saving to build. This is the context in which Trump's approach becomes economically dangerous. He governs from confrontation, not consensus. He wields deadlines like weapons. He demands public loyalty tests from lawmakers who manage budgets affecting millions of households. Markets can factor in ideology. They cannot factor in impulsiveness. And this brings us to the quiet shock sitting beneath all these numbers. America is losing the premium investors traditionally paid for its stability. That premium is invisible until it disappears. You see it only in the increased cost of borrowing, in the shrinking of multiples, in the sudden fragility of pensions that once felt indestructible. When trust weakens, capital retreats, gently at first, then all at once. Look back at our retiree. Her mix of equities and bonds once assumed a stable political foundation. But the moment Washington turned defense funding into a test of political obedience, Her diversified portfolio behaved like a leveraged bet on congressional discipline. She never asked for that risk. She never voted for that risk, yet she's carrying it. This is why I stress that political spectacle carries a real price. One you pay quietly, line by line, statement by statement. Line by line on a statement is how you notice the loss year by year in policy, is how that loss becomes permanent. When political spectacle becomes routine, investors don't wait for the next crisis to adjust. They quietly rewrite the rules they use to price everything you own. A county in Virginia that used to borrow for school construction at 3.2% now faces 3.9% because underwriters are building in governance risk. That extra 0.7 percentage point sounds small. Over 15 years, it adds roughly $28 million in interest on a $300 million program. That money doesn't come from nowhere. It comes from higher local taxes, deferred maintenance, and smaller cost of living raises for public workers whose pensions intersect with your own investments. You see the same pattern in corporate decisions. A mid-sized contractor in Texas decides not to bid on a new long-term Navy project because its board no longer believes Washington keep a 5-year funding promise. Instead, it shifts 40% of its capital budget into shorter contracts with commercial clients, even though the margin is lower. To the market, that is a rational response to erratic politics. To a 58-year-old welder who planned to stay with that company until Medicare age, it is the difference between a predictable career and a string of unstable jobs with thinner benefits. Trump's style accelerates this shift. He treats conflict as proof of strength and compromise as weakness. He pressures his allies on the Hill to show loyalty by holding up basic functions of government. Over time, that behavior doesn't just move prices, it moves culture inside institutions. Young staffers learn that grandstanding beats problem solving. Legislators learn that a threatened shutdown gets more airtime than a quiet deal. Before long, the idea that budgets must be passed on time is no longer a norm. It's a negotiating chip. For capital, this change is profound. I've spent my life buying businesses that respect continuity. I know what it looks like when an organization decides that drama is more valuable than discipline. Vendors shorten payment terms. Banks demand more collateral. Long-term investors demand a wider margin of safety. The same thing happens to countries. When leadership signals that brinkmanship is the new normal, global capital responds by building in a permanent penalty. That penalty shows up as higher borrowing costs for the government, lower valuations for its companies, and thinner cushions for its retirees. Project that out 10 or 20 years. If the United States pays even half a percentage point more on average to borrow because of persistent political games, the additional interest over a decade can easily run into hundreds of billions of dollars. That is money that could have shored up Social Security, stabilized Medicare, improved infrastructure, or simply reduced the pressure to raise taxes. Instead, it becomes a quiet fee paid for the privilege of watching leaders act reckless. At the household level, the damage looks like this. A 62-year-old couple postpones retirement twice because each time markets wobble around another manufactured showdown in Washington, their advisor urges caution. A teacher in Michigan sees her pension plan nudge its assumed return down from 7% to 6.1%, forcing higher contributions from her paycheck. A small business owner in Arizona rolls her credit line at 8.3% instead of 6.9% because her bank now treats government-related industries as higher risk. None of these people wrote a single line of legislation, but all of them are paying for the way that legislation is made. There is also a generational cost. When younger workers watch this cycle repeat, they internalize a lesson. Institutions are unstable, promises are fragile, and politics can blow up their savings at any time. They respond by speculating more, saving less, or parking too much in cash. All three choices reduce the power of compounding. A country where people don't trust the rules to hold is a country where people don't commit for the long term. That's how an advantage erodes without a headline. Trump didn't invent polarization, but he has normalized a style of leadership that treats the economy as a stage prop. Each time he encourages lawmakers to weaponize a budget, each time he signals that loyalty to him outranks loyalty to process, he He chisels away at the expectation that the system will behave like a reliable counterparty. Markets notice. They don't make moral judgments. They make probability judgments, and they are slowly concluding that American governance is more uncertain than it used to be. My advice to you, as someone who has watched many storms, is simple. Do not assume that what felt safe in the past is automatically safe under this new pattern. Diversify not just across companies, but across kinds of risk. Favor businesses and funds that can survive higher financing costs and political noise without changing their basic character. Be cautious with anyone who promises to protect you by stoking more confrontation. They are usually adding volatility to the very system that supports your savings. Most of all, understand that trust is not an abstract word in an economics textbook. It is the invisible line item that keeps your cost of living manageable, your retirement plausible, and your children's opportunities open. When leaders burn that asset for short-term applause, the bill lands sooner or later in your mailbox.